Welcome back to our channel, Elevate Equities. Today, we have an exciting topic to discuss, especially for those who are new to investing. Yes, you guessed it right. We will be talking about the basics of investing in stocks for beginners. Investing in stocks can seem intimidating at first, but with the right knowledge and understanding, it can be a rewarding journey. So, let's dive right in and learn the fundamentals of stock investing. What are stocks? Let's start with what stocks actually are. Stocks are a type of security that gives stockholders a share of ownership in a company. Companies sell shares typically to gain additional money to grow the company. This is called the initial public offering, IPO. After the IPO, stockholders can resell shares on the stock market. Stock prices rise or fall and are typically driven by expectations of the corporation's earnings or profits. Potential benefits of investing in stocks. The potential benefits of investing in stocks include potential capital gains from owning a stock that grows in value over time, potential income from dividends paid by the company, lower tax rates on long-term capital gains, potential risks of stocks. The potential risks of investing in stocks include share prices for a company falling, even to zero. If the company goes broke, you may be the last to be paid, so you may not get your money back. The value of your shares will go up and down, and the dividend may vary. How to invest in the stock market. 9 tips for beginners. Now let's start with the potential tips for you to follow as a beginner. Watch the video till the end so that you don't miss any of these tips, which we have researched on for you. Number 1. Buy the right investment. Buying the right stock is so much easier said than done. Anyone can see a stock that's performed well in the past, but anticipating the performance of a stock in the future is much more difficult. If you want to succeed by investing in individual stocks, you have to be prepared to do a lot of work to analyze a company and manage the investment. When you start looking at statistics, you've got to remember that the professionals are looking at each and every one of those companies with much more rigor than you can probably do as an individual, so it's a very difficult game for the individual to win over time. If you're analyzing a company, you'll want to look at a company's fundamentals, earnings per share, EPS, or a price-earnings ratio, for example. But you'll have to do so much more. Analyze the company's management team, evaluate its competitive advantages, study its financials, including its balance sheet and income statement. Even these items are just the start. You'll have to study the company and anticipate what's coming next, a tough job in good times. Number 2. Avoid individual stocks if you're a beginner. Remember, to make money consistently in individual stocks, you need to know something that the forward-looking market isn't already pricing into the stock price. Keep in mind that for every seller in the market, there's a buyer for those same shares who's equally sure they will profit. An alternative to individual stocks is an index fund, which can be either a mutual fund or an exchange-traded fund, ETF. These funds hold dozens or even hundreds of stocks, and each share you purchase of a fund owns all the companies included in the index. Unlike stock, mutual funds and ETFs may have annual fees, though some funds are free. Number 3. Create a diversified portfolio. Diversification is important because it reduces the risk of any one stock in the portfolio hurting the overall performance very much, and that actually improves your overall returns. In contrast, if you're buying only one individual stock, you really do have all your eggs in one basket. The easiest way to create a broad portfolio is by buying an ETF or a mutual fund. The products have diversification built into them, and you don't have to do any analysis of the companies held in the index fund. When it comes to diversification, that doesn't just mean many different stocks. It also means investments that are spread among different industries, since stock in similar sectors may move in a similar direction for the same reason. Number 4. Be prepared for a downturn. The hardest issue for most investors is stomaching a loss in their investments. And because the stock market can fluctuate, you will have losses occur from time to time. You'll have to steel yourself to handle these losses, or you'll be apt to buy high and sell low during a panic. As long as you diversify your portfolio, any single stock that you own shouldn't have too much of an impact on your overall return. If it does, buying individual stocks might not be the right choice for you. Even index funds will fluctuate, so you can't get rid of all of your risk, try how you might. That's why it's important to prepare yourself for downturns that could come out of nowhere. You need to ride out short-term volatility to get attractive long-term returns. One of the interesting things is that you will see the markets volatile because the market's going down. Of course, when it's going up, it's also volatile, at least from a statistical standpoint. It's moving all over the place. So it's important for you to say that the volatility that you're seeing on the upside, you'll also see on the downside. Number 5. Try a stock market simulator before investing real money. One way to enter the world of investing without taking risk is to use a stock simulator. Using an online trading account with virtual dollars won't put your real money at risk. You'll also be able to determine how you would react if this really were your money that you gained or lost. That can be really helpful because it can help people overcome the belief that they're smarter than the market, that they can always pick the best stocks, always buy and sell in the market at the right time. Number 6, stay committed to your long-term portfolio. Investing should be a long-term activity. You should divorce yourself from the daily news cycle as some of the news cycle. At times it becomes 100% negative and it can become overwhelming for people. By skipping the daily financial news, you'll be able to develop patience, which you'll need if you want to stay in the investing game for the long term. It's also be useful to look at your portfolio infrequently so that you don't become too unnerved or too elated. These are great tips for beginners who have yet to manage their emotions when investing. One strategy for beginners is to set up a calendar and predetermine when you'll be evaluating your portfolio. Sticking to this guideline will prevent you from selling out of a stock during some volatility or not getting the full benefit of a well-performing investment. Number 7, start now. Choosing the perfect opportunity to jump in and invest in the stock market typically doesn't work well. Nobody knows with 100% certainty the best time to get in, and investing is meant to be a long-term activity. There is no perfect time to start. One of the core points with investing is not just to think about it, but to get started, and start now. Because if you invest now, and often over time, that compounding is the thing that can really drive your results. If you want to invest, it's very important to actually get started and have an ongoing savings program so that we can reach our goals over time. Number 8, avoid short-term trading. Sometimes short-term investors can have unrealistic expectations about growing their money, and research shows that most short-term investors, such as day traders, lose money. You're competing against high-powered investors and well-programmed computers that may better understand the market. New investors need to be aware that buying and selling stocks frequently can get expensive. It can create taxes and other fees, even if a broker's headline trading commission is zero. If you're investing for the short term, you risk not having your money when you need it. Depending on your financial goals, a savings account, money market account, or a short-term CD may be better options for short-term money. Experts often advise investors that they should invest in the stock market only if they can keep the money invested for at least 3 to 5 years. Money that you need for a specific purpose in the next couple years should probably be invested in low-risk investments, such as a high-yield savings account or a high-yield CD. Number 9, keep investing over time. It can be easy to dump your money into the market and think you're done. But those who build real wealth do so over time by adding money to their investments. That means having a strong saving discipline, holding back some of your paycheck so that you can put it to work in the stock market. You'll be able to put more money to work and grow your wealth even faster. You may already be doing this if you have a 401k retirement account, which takes money from your biweekly pay and puts it into the investments you've selected. Even if you don't have a 401k, many brokerage accounts allow you to set up automatic transfers to your account. Then you may be able to set up automatic investments at a broker or one of the best robo-advisors. You can automate the process of investing, helping to keep your emotions out of the process. That's it for today's video. I hope you found this introduction to investing in stocks helpful. If you have any questions or want to learn more, feel free to leave a comment below. Don't forget to subscribe to our channel for more informative videos on investing and personal finance. Thanks for watching and happy investing.